Conference call hosted by HDFC Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. And I'll hand the conference over to Mr. Nilesh Ghuge from HDFC Securities. Thank you, and over to you, sir.
Thank you, Nirav. Good afternoon, all. On behalf of HDFC Securities, I welcome everyone to this Aether Industries conference call to discuss the results for the quarter and financial year ended March 2024. From Aether Industries, we have with us today Dr. Aman Desai, Promoter and Whole-Time Director, Mr. Rohan Desai, Promoter and Whole-Time Director, Mr. Faiz Nagaria, Chief Financial Officer, and Ms. Shubhangi Desai, Executive IR. Without further ado, I will now hand over the floor to Ms. Shubhangi Desai to begin with the earnings call for Q4FY24 and financial year 24. Over to you, Shubhangi.
Thank you, Nilesh. Good evening, one and all. Today, on May 21, 2024, our board has approved the financial results for the fourth quarter and financial year ended on March 31, 2024, and we have released the same to the stock exchanges as well as updated the same on our website. Please note that this conference call is being recorded and the transcript of the same will be made available on the website of Aether Industries Limited and exchanges. Please also note that the audio of the conference call is the copyright material of Aether Industries Limited and cannot be copied, rebroadcasted, or attributed in press or media without specific and written consent of the company. Let me draw your attention to the fact that on this call, our discussion will include certain forward-looking statements which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations on future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our actual results to differ materially from what is expressed or implied. Aether Industries Limited or its officials do not undertake any obligation to publicly update any forward-looking statements, whether as a result of future events or otherwise. Mr. Rohan Desai will begin by sharing Aether's business outlook. Then Mr. Faiz Nagaria will cover the financial highlights for the period under review. And Dr. Aman Desai will share the ongoing expansions and strategy of the company going forward. Now I shall hand over the call to Mr. Rohan Desai for his opening remarks. Over to you, sir.
Thank you, Shubhangi. Ladies and gentlemen, thank you for joining us today. I want to address our recent quarterly performance, which was unfortunately impacted by the significant fire accident. The foremost priority of the company immediately after the accident was towards the injured and for the family members of the deceased. And we have done our very best for them and their families. Coming to the business, while this event has certainly present challenges, we would want to assure you that we are fully committed to addressing the situation and mitigating its effects. Our team is working tirelessly to rebuild what is lost, get the production streams online in phase-wise manner after getting necessary statutory approvals, and ensure the safety of our employees and facilities. During the start of this quarter, we had announced that we had restarted 50% of the facility post this accident. This came online in stepwise manner, and hence the effect is seen in our performance. Our swift response and effective crisis management systems minimized the disruption of our supplies and enabled us to meet our commitments to our customers to the best of our abilities. The other half of the affected site too is expected to be operational soon with all the safety protocols in place. We are expecting to receive revocations of the closure order of Site 2 to resume operations to the extent of 75% and 100% of the environmental clearance capacity shortly. We have taken several one-time hits on our books which has impacted our bottom line. We appreciate your patience and support as we navigate through this challenging time together. There has been several positive developments in this quarter. We had announced the successful piloting of recycling and upcycling of plastics with our customer Novolu. Also, we had announced the appointment of our new CTO at Aether, Dr. James Ringer, who has taken up this role after already being here with us for 3+ years. We have also invested in 15 megawatts of solar power plant, which will make us 95% sustainable on renewable electrical energy in 3 sites. And last but not the least, we have commercialized Site 4, which starts the production meant for oil field drilling services businesses. Dr. Aman would be sharing more information on the above in the short period of time. In spite of the pricing pressure and the fire accident at Site 2, we have been able to sustain the market of our products, and we are seeing a good inflow of orders in our existing molecules. Our large-scale manufacturing business model contributed to 59% of the total sales in this quarter. CRAMS contributed to 14%, and contract/exclusive manufacturing was at 26%. Robust growth in all these 3 business segments is expected in the current financial year 2024-25. We will have the Site 2 fully getting operational by Q1 of 2024-25, wherein we are expecting the revocation orders for Site 2 to come anytime from the authorities. Now, let us discuss on the growth outlook from here on. We have commissioned our Site 4, which is under 100% wholly owned subsidiary, Aether Specialty Chemicals Limited. This has been created largely for one of the top 3 biggest oil field services company. We had announced the letter of intent with this company in the recent past, leading to the creation of this site. And we expect to be announcing the finalized strategic supply agreement with this customer shortly. Production and the supply of the products from Site 4 to these customers will be increasing in phases, with the first phase beginning from Q1 of financial year 2024-25. By the coming quarters, we anticipate a very significant revenue contribution from Site 4 in this oil field services domain. Site 3, which was commercialized in January 2023, has seen pricing pressures also, and we have not been able to get the desired results, but we expect the pricing pressures to ease out soon, and we will get the desired results in financial year 2024-25. Commercialization of Site 3++ and launch of 3 to 5 products in Site 3++ under the LSM model in Q4 of financial year 2024-25 is on track. Commissioning of the new 15 megawatt solar power plant will be adding to saving of electricity expenses, which will be done in 3 phases. Phase 1 will come online in the end of May 2024. Second phase will come online by July 2024, and the last phase will start in September 2024. Each phase would be of 5 megawatt capacity. We have also successfully expanded and commissioned the pilot plant. This will further lead to enhancement and faster scale-up of newly developed products in R&D, which are to be launched in the near future. This expanded pilot plant also helps us in expanding our CRAMS business model in a significant footing. I would now request Faiz to take you through all the financial highlights of the company. Over to you, Faiz.
Thank you, Rohan. Good evening, everybody. I hereby present the financial results of Aether Industries Limited for Q4 and financial year 24. The total revenue of the company in standalone stood at rupees 6,399 million in financial year 24, as against rupees 6,676 million in financial year 23, resulting in an EBITDA of 1,619 million in financial year 24, as against 2,028 million in financial year 23. EBITDA margin stood at 25% in FY24, as against 30% in FY23. The PAT amounted to INR 881 million in FY24, as against INR 1304 million in FY23. The PAT margin stood at 14% in FY23, against 20% in FY23. The consolidated financials are here with total revenue of the company stood at 6,373 million in financial year 24 as against 6,676 million in financial year 23, resulting in EBITDA of 1,577 million in financial year 24 as against INR 2,028 million in financial year 23. The EBITDA margin stood at 25% in FY24 as against 30% in FY23. The PAT amounted to INR 825 million in FY24 as against INR 1304 million in FY23. The PAT margin stood at 13% in FY24 as against 20% in FY23. The loss in Q4 is attributable to deferred tax provision in Aether Specialty Chemicals Limited due to operation started in March 24 and capitalization of various fixed assets, that is rupees 11.03 million. Otherwise, there is a PBT of rupees 5.6 million and there is a cash profit as well. The main reason for the reduction in the revenues in Aether Industries is attributable to the fire accident at our Site 2 in November 2023, wherein the production at our manufacturing facility 2 was stopped for a couple of months. The reduced revenues and other exceptional expenses related to the accident, like compensation paid to the families of the deceased, penalty payment to GPCB, medical treatment expenses of the workers who were hospitalized, and increased insurance premium of our IR policy have resulted in the reduction in the EBITDA and PAT margins eventually. The amount of such one-time cost is approximately 70 million for the quarter. We incurred an incremental impact of approximately 30 million on account of increase in insurance premium due to a fire accident in this financial year 24. Further, we have also incurred a loss of rupees 138.97 million on account of damage of inventories in process and finished goods, which were either in the reactors, other equipment, and on the shop floor when the fire accident happened. The loss of fixed asset is being assessed as various equipments are being inspected as the results and the outcome are expected to be released by the end of this month. We have though submitted our first claim of rupees 1,000 million to the insurance company towards stocks, fixed assets, loss of profit, etc. And we have applied for an on-account payment of rupees 210 million to the insurance company, which has been approved, and we expect the payment in due course in few days. Acceptance of on-account payment also entitles that our claim is accepted by the insurance company, which will be settled in next few months. Due to the fire accident at manufacturing facility 2, that is plant 2 majorly affected, new production could not be done in the entire December 2023 and January 2024, and hence this also led to the reduction in the finished goods and semi-finished goods inventories, resulting in a reduced margins as well. Though when we received the partial revocation orders from the authorities, we started building up stocks of RM. Manufacturing started, resulting in increasing stocks of SFG as the production is going on for various products. I'll stop here and request Dr. Aman Desai to share updates on Aether's ongoing expansion plans and strategies going forward.
Good evening, everybody. Despite the unfortunate turn of events in this fiscal year impacting our quarterly and overall performance, our team's resilience and dedication have allowed us to navigate through this difficult situation. Our swift response and effective crisis management systems have minimized the disruption of our supply chain and enabled us to meet our commitments to our customers to the best of our ability.
We are losing your audio. Can I request you to speak a little louder, please?
Yeah, no problem. Please let me know if it is not audible. In January, the unaffected plants of our fire-impacted Site 2 resumed operations after an initial closure by the GPCB. The other half of the affected Site 2 is expected to be operational very soon with all the safety protocols in place. We're expecting to receive revocation of the closure order of Site 2 to resume operations to the extent of 75% of our capacity in the next coming days. With that, let me put forth the strategic developments that have been executed and which remain the key drivers during the period under review. We announced the first commercialization of the novel converged polyol technology, which we had developed in collaboration with Saudi Aramco, and this first commercialization was led by one of the largest US-based adhesives manufacturer, HB Fuller. This builds on the numerous years of joint work done so far on the converged platform with Saudi Aramco Technologies Company. As we speak, we are continuously working to widen the array of converged polyols application in the cake industry. We are upbeat on the fact that this successful product launch by HB Fuller is the first of many, with an aim to serve the customers by providing sustainable solutions. As these first launches of the converged polyol technology begin, we are hoping now to see a rapid growth in the commercialization and sales of these novel and sustainable polyols. We are also proud to partner with Novelis
for a first of its kind life cycling process, creating a pathway for circular plastic future. This technology provides an economical and sustainable solution for hard to recycle plastics. This project is a plan to unfold in phases, with an initial startup of operations already commenced in the first quarter of the fiscal year 25 at the newly built pilot plant dedicated to the project. Novelift's Novel technology has immense potential, and we are excited to begin preliminary discussions with Novelift already towards the full-scale commercialization at Aether of this technology in the very near future. In the recent past, we have announced partnerships with Polaroid of Netherlands and Otsuka of Japan. Both these partnerships remain robust. We continue to be the exclusive research, development, and supply partner for Polaroid digital and instant photography platforms. This upcoming fiscal year will see substantial revenue contributions coming up for the first time from our partnership with Otsuka, thus transforming the work done over the last several years and building this partnership into a substantial commercial business. We also recently announced the execution of an agreement with a major global lithium-ion battery producer, thereby giving an announcement for our foray into specialized electrolyte additive products. We have partially commercialized these products already and expect full commercialization in our upcoming Sites 3++ and Site 5. Additionally, this partnership is developing quite well, and we expect additional benefits from this partnership, which we will also announce in due course of time. Our R&D and pilot plant assets, infrastructure, and manpower continue to increase quarter on quarter, even in the accident-affected quarters. This reflects on the continued fullness of our R&D pipeline, with numerous projects across all business models. Even with the recent setbacks, our CRAMS portfolio has in fact grown year on year, and we anticipate the upcoming fiscal year will see a significant expansion of this CRAMS portfolio, with new projects and new customers being added across the industry spectrum, and a few of these products making the golden transition from the CRAMS portfolio to the contract/exclusive manufacturing portfolio. We had also given guidance on the hierarchical changes that we are planning to bring about, especially in the wake of the accident. In line with that, we have announced Dr. James Ringer as our CPO, who has already been associated with us since the last 3 years as a business development leader for the Americas. He's a very well-recognized R&D professional with a career spanning more than 30 years at the Dow Chemical Company in the USA at an R&D director level. He will be jointly overseeing the R&D and technology verticals of the company. Under his leadership, we look forward to maneuvering to greater heights in strategic innovation and technical leadership in cementing our place as a premier partner for chemical development, scale-up, and manufacturing across the industry spectrum. We have commissioned successfully our Site 4 under our 100% wholly owned subsidiary, Aether Specialty Chemicals. This has been created largely for one of the world's 3 biggest oil field services companies in the U.S. We had announced a letter of intent with this company in the recent past, leading to the creation of this Site 4, and we expect to be announcing the finalized strategic supply agreement with this customer in the coming weeks or even days. Production and supply of products from this Site 4 to this particular customer will increase in phases, with the first phase beginning in this first quarter of fiscal 2025. By the coming quarters, we anticipate very significant revenue contribution from this Site 4 in the oil field services domain. CAPEX at our greenfield manufacturing Site 3++ and Site 5 is advancing well, with all the regulatory approvals in place and the civil work going on as planned, and the machinery and equipment also being installed in Site 3++. We anticipate the commissioning of Site 3++ by the end of this upcoming fiscal year. We are going to launch several exciting new products in this Site 3++ for both the large-scale manufacturing business model as well as the contract exclusive manufacturing business models. These products are, as always, made and offered by us for the first time in India, have their genesis in our core chemistry and technology competencies, and have been painstakingly developed in our R&D labs and made production ready in our pilot plant. The products under planning for this Site 3++ include some of the new electrolyte additives and 2 large molecules moving from the CRAMS portfolio to the contract exclusive manufacturing portfolio, and pipeline molecules under our large-scale manufacturing business model made by us for the first time in India. Site 5 is developing quite well from the civil project perspective. It is a mega production site with 16 production blocks and is shaping up very well to become the true face of production of Aether Industries with world-class engineering, technology, and safety and sustainable systems. At the very end, I do want to touch upon the tragic and unfortunate accident in our manufacturing facility in Site 2 in the last quarter. As Rohan had mentioned at the start of this call, the topmost priority of the company, our management, and our family has been towards the injured and the families of the deceased. We have tried our very best to stand by them, and we will continue to do so for the lifetimes of these immediate families. This was a major accident. We have responded by undertaking comprehensive and systemic changes in the safety protocols and processes of the company. Each and every single operation being conducted in R&D, pilot plant, and production for all the sites in the company have been reviewed for safety, and only then have operations been resumed. We have spent several weeks in drawing up an elaborate corrective and preventive action plan, which focuses equally on the short term, the medium term, and the long term. This plan has already been implemented and validated for the short-term actions and is being implemented with utmost seriousness for the medium-term and long-term actions. Rigorous implementation of this plan remains the company's topmost priority, and it is also my personal topmost priority. As a company, as a family, and as the person leading the operations, we are and I am committed to ensuring that such an event will never ever happen again at Aether Industries. Finally, I do want to express our deepest gratitude to all our colleagues, our stakeholders, and our value investors in their continued faith and trust in us, and I assure you that we are working tirelessly to ensure that we deliver value to you and live up to our promise and potential. Shivangi, back to you.
Thank you, Doctor. We shall now request the moderator to open the forum for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Rohit Nagaraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So first question is in terms of competition from China. So we've been hearing across the board that there has been competition from China which has cropped up over the last couple of years. So have we faced any competition? And because of the incident, is there any irreversible market share loss that we are experiencing? That's the first question. Thank you.
Thank you, Rohit. On the pricing side, yes, we are seeing a lot of pressure from China because the raw materials have also reduced, and obviously they are back to their original state. So we are facing good competition in terms of pricing. However, we have only lost certain market share in certain products because of our inability to produce, because we have only 50% of our production plant which is online. So that product is where we have lost some market share, but we are very, very confident that we will regain this market share in Q1 and Q2 respectively, and will be back to our original state. We have commitments from the customers and their readiness from the customer side and their willingness to buy from Aether. So we are not worried on the existing molecules. And we are already taking a lot of orders with anticipation of restarting of the plant as per our internal timelines.
Sure, that's helpful. Second question is in terms of the newer capexes. So if you could just give us a timeline as to when commercialization of these projects will happen, and what kind of revenues that we are expecting over a period of time. So maybe at peak utilization based on the current capex, and how the trajectory would move maybe in FY26, 27 in terms of overall revenues. Thank you.
Right. So we are talking about Site 3++. To start with, Site 3++ is 200 crores of investment, and it is expected to come online and stabilize in Q4 of this financial year, 2024-25. Site 4 is already up and running, and we are seeing the output and the sales happening in phase-wise manner, where it is being ramped up in this current quarter, that is Q1 of 2024-25, and it will attain its full potential in Q2 and Q3 respectively of this current financial year 24-25. And talking about Site 5, we are estimating our getting online in a phase-wise manner, where the first phase will get online in December of 2025, which will stabilize in the last quarter of 2025-26, and the potential will start unlocking in 26-27 for that site. This is expansion of 500 crores of revenue, capital investment, out of which 300 crores would be productive assets and 200 crores would be non-productive assets. That is the accessories and the infrastructure around which we need to build up for 16 production blocks. Does this answer your question, Rohit?
Sure. Just one small clarification in terms of the usable asset base. What would be the asset terms that we are looking at?
At maturity, after a period of 2 years of stabilization of the plant, we are looking at 2x of the investment done in the plant.
Sure. That's helpful. Thanks a lot and best of luck.
Thank you, Rohit.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Dhruv Shah from Dalal & Broacha Stockbroking. Please go ahead.
Thank you for the opportunity, sir. So my first question is...
Dhruv, sorry to interrupt you. Can you speak a little louder, please?
Am I audible now?
Little better, thank you.
Yeah. So for my first question is with respect to your CRAMS business. If I look at your full year revenue, it has been kind of flattish. Can you justify what is the reason behind this flattish growth?
So quite a few of on the wake of the accident, quite a few of the projects were put on hold, and there's almost a period of overall, I believe, 2 months where we put a lot of things on hold. As I mentioned in my speech, we have done a thorough safety review of every single operation and every single project. And for that matter, we have put quite a few projects on hold, and quite a few of the bigger projects were put on hold for a longer time for these safety reviews. And so we are looking at least 1 quarter where we were delayed by our deliverables and milestones on all of these projects. And so, in fact, we were hoping to have a showcase of significant growth on the CRAMS year on year. But in spite of this setback of 2 to 3 months, we've still grown on the CRAMS by a couple of percentages, I believe, and I think that reflects on how strong the pipeline was.
Sure, sir. Thank you. So my second question was, what was your average selling price per kg for the full year?
At the moment.
Yeah, average selling price per kg was 1,509 rupees.
1,509 rupees?
Yeah.
Yeah. And sir, what is your outlook on this? Are you seeing any improvement in prices? Because the prices have been falling only, right? So are there any green shoots that you are observing in terms of prices?
Currently, for Q1 and Q2, no. We are not expecting any price to be correcting, but we are seeing a good demand, at least to start with, which is a very, very positive note. and with the demand, we hope that from Q2 onwards, the pricing will go towards the north.
Sure, sir. And my last question was with respect to your agrochem sector. So what is the scenario over there? Are there any improvements over there? Because I think so earlier you had mentioned that some deals were delayed, not cancelled. So are they back with us, or they still not with us yet?
Yes, so we are not a major agro player as such. We hold approximately 30-35% of our sales comes out of 4 products which are in agro, and we are not seeing demand trouble in these 4 products. However, the pricing pressure is still true in all these 3 for all these 4 products.
Sure, sir. And just one last question, if I could squeeze in. So there has been some significant increase in your non-current borrowings. So can you please mention what is that regarding?
Non-current borrowings is the working capital requirements which we have started taking, because we had taken 45 crores in the for working capital. So these are being used for
your voice wasn't audible. Can you please repeat that?
Yeah, sir. The non-current borrowing are the working capital limits which we are enjoying with the banks. So these are towards CC, PCFC, and LC limits which we are using from the banks.
Okay, sir. Thank you. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Inderjeet Bhatia from HDFC Securities. Please go ahead.
Yeah, hi Aman. Hi Rohan. Yeah, hi guys.
Hi.
First question is, would you want to kind of put a number as to how much of revenues we lost in the previous quarter because of this unfortunate accident? Is there some assessment of that?
We lost almost close to 150 to 200 crores of revenue, which we are assuming in 2 quarters. I mean 4 months.
Okay. So there are many aspects. So we lost 1 quarter in Site 4 also, which we were anticipating to get as a revenue, which was oil field drilling services, which was also delayed because we wanted to do the safety reviews and safety checks again in the existing site and the Site 4. And also we had a QHS which was kicked in by our customers, which we passed with flying colors also. Okay. So this is, when you say 150 crores of revenue lost, is this revenue delayed, which will all expected to come into FY25? Or do you think some part of this is actually lost because those orders do not exist any longer with us? Because customer might have shifted it.
No, so it has been pushed quarter back, so we are not going to recover it in this financial year for sure.
Got it. Second is, now with you said that we are not large players in agro, but if I recollect, agro was still a fairly substantial portion of our order of our revenues. If you could kind of just let us know as to what percentage do you think would be agro in FY25 or FY26 once all these new capacities come up. That is one. And the second is, in any of your existing contracts or the new contracts that you have kind of got, has there been any change in pricing or any kind of extra cost that is associated either because of this accident or just generally because of, say, the environment changing?
No, so no additional cost has been put in by Aether, or there is no discount which is being given by Aether because of the accident. We are anticipating a 30 to 35% of our total top line to be agro for this financial year.
Got it. Thank you. That's it from my side. Best of luck for the party.
Thank you.
Thank you very much. Next question is from the line of Atish Rai Madan from Fortress Group. Please go ahead.
Hi, good evening. Thanks for the opportunity. I have a few questions regarding the converged polyols opportunity. Firstly, so you previously mentioned that the addressable market size for the converged polyol opportunity is about 850,000 tons per annum. Can you maybe quantify the TAM in dollar terms?
So 150 KTA would be at the average selling price of $4 to $5 a kilo. Sorry, $3 to $5 a kilo. Sorry.
Okay. Thank you. So just harping upon that point, I mean, considering that the converged polyols are more value-added products compared to the other polyols used in case applications, are they being priced at a premium compared to the other polyols in the market?
Yes, it is priced at a premium, and it is approximately 35%, 30 to 35%, depending on the volume which you require. It is at a 30 to 35% premium.
Okay. Thank you. And just a quick follow-up on that. So for the various case applications that you're targeting, what percentage of the end-use applications' total COGS would be attributable to polyols? I understand that the exact figure would be difficult to estimate. Even a range would be very helpful.
That would be difficult to estimate, I think.
Okay, fair enough. I have a couple more questions, but I guess I'll just join back in the queue for those.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yes, hi Rohanji, Faizji. Thank you for taking my question. Just two small questions from my side. First is on the volume or revenue growth which you are targeting in FY25. Given some new plants are coming up and there would be certain impact inside to in 1Q25. So just some thoughts on there.
Yeah, so Q1 we are anticipating the site to come online. So at any time you are expecting a revocation to be circulated, and so we can push and move ahead, full steam ahead in site 2. And site 4 has come online, so that will contribute quite a lot in financial year 2024-25.
Okay, so you are at this point you are probably not putting a number to the growth guidance that you have. Is that understandable?
No, really not.
Yeah, no problem. And the second question I had was on the working capital days. So, how much of the moderation you are expecting in FY25? Given I think we had some higher working capital days in 24. So, how do you see?
Krishan, can you just speak a bit louder? I cannot hear you.
Sure. So I was actually asking, was there any particular reason for higher working capital days in FY24, and how much of moderation we are expecting in FY25?
So the main reason for the increase is attributable to the inventory days, wherein the work in progress inventory has gone up. So we had a fire incident, and then the site 2 revocation for part was received, and we started the production in February. So this production was going on. So this work in progress inventory has been high at this side, and this will moderate, and we will again come back to the normal scenario and normal terms by end of this financial year 25, for sure.
Perfect. So essentially, it was because of the fire incident. Understood. So
yeah,
I think
various production was to be started. Otherwise, the raw material, finished goods, all the inventory days are all in control. There is no such problem.
Perfect. So we can expect it to be a normal level once again.
Correct. Yes.
Thank you. Thank you for patiently answering my question, and wish you all the best.
Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. Next follow-up question is from the line of Atishray Marhan from Fortress Group. Please go ahead.
Yeah, hi. Just a couple more follow-up questions on the electrolyte additives opportunity. So the electrolyte additives that you're currently developing, how fungible are they? Can they be used across different electrolyte salts and solutions, or are they specific to a specific electrolyte salt, such as, say, a lithium hexafluorophosphate?
Yeah, thanks for the question. Great question. We are focusing only on the organic molecule, small organic molecule electrolyte additives, and that's a very specific subset of the electrolyte additives. And so we are not going after the salts, we are not going after the solvents, we are not going after the salt additives, we are going after the organic small molecule electrolyte additives only, which play to our strengths of our core competencies of chemistries and technologies. And so that's the first part of the answer. The second part of the answer is that these are commonly used. So 2 out of the 3 that we are developing are very commonly used electrolyte additives in almost every single formulation of lithium-ion batteries. And so they are going to be broadly applicable and marketable to the entire world of the lithium-ion battery formulation partners. And the chemistry play and the technology play to our strengths of core competencies and therefore are fungible in our manufacturing assets.
Okay, thank you. So my understanding is that you plan on sending the first validation batches to the client by the end of this calendar year. Is that correct?
That is correct, yes. By hopefully before that.
Okay. So, I mean, when do you expect commercialization of the additives by?
So the commercialization will be partially done by the end of this calendar year, and the full commercialization will happen in the site 3++, which will be by the end of this fiscal year or the quarters thereafter.
Okay. Thank you so much. Thank you so much for your detailed responses. Good luck for the forthcoming quarters.
Thanks a lot for your question.
Thank you. Participants, you may press star and 1 to ask a question. Next follow-up question is from the line of Rohit Nagraj from Centrum Broking Limited. Please go ahead.
Yeah, thanks for the follow-up. So we have recently, elevated doctor for the CTO position. So what is the structure that we are working with? I mean, in terms of the total staff cost, how much is the percentage for the expats? And to retain them for a fairly long period of time, what is the incentive structure or probably ESOP structure that we have formulated? You can just give some color on this. Thank you.
Yeah, so we're very excited to have Jim on the board. And Jim's personally known to me for the last 20 years now, and with the company for 3 years already. And he's probably one of the best process scientists in the world that I know, and I know quite a few. And so we are excited to have him, and he's joined us obviously for a good package, but also and benefits, but also because he believes in the story and of the personal connection that we share. And he's very excited to be working with us. And so obviously I won't share the details here, but there are several aspects of the overall package that we have put together for him, and it includes obviously attractive ESOPs as well. He already had access to ESOPs from the business development leader position that he was in, and this gives additional benefits to him as well. And so we work very closely. He is at Aether for a full month every quarter, and he's working in the Indian time zone, partially over there in the US for coordinating with the projects over here, and then partially in the US time zone for the business development activities. And so he's already contributing immensely to all the projects, and it's a parallel structure to me, if you will, in terms of the R&D and technology development of the company. And so it's very, very positive. Hopefully that answered some of your questions.
Right. And a similar structure is in place even for the other expats who are working from other geographies?
The other business development team has ESOPs and a reasonably good package as compared to the Indian standards. That's already in place. So the design of the structure is done in such a way that it is expandable for the near future if anybody wishes to join it.
Sure, sure. And just one clarification in terms of FY25. Given that the unfortunate incident has happened and probably we'll get the revocation order in some time, is it safe to assume we will be able to do at least similar kind of revenue run rate what we did in FY24, barring the new projects which have come on stream in terms of the Site 4 and the upcoming projects?
Obviously. Yeah, for sure.
Sure. Thank you so much and best of luck.
Thank you.
Thank you very much. As there are no further questions, I will now hand the conference over to the management for closing comments.
Thank you everyone for participating in the call. We hope that we have addressed majority of your questions. If you still have any further questions, please feel free to reach out to us. Thank you.
Thank you very much. On behalf of HDFC Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.